All right, let's get right into it. On paper, it's the ultimate matchup, right? Porsche versus Ferrari. But we're not here to talk lap times. Nope. Today, it's all about business strategy. Thanks to a really sharp analysis from HDIN Research, we're going to unpack this massive clash between two luxury giants and see how their billion-dollar bets are shaping the entire future of performance cars.
And it really boils down to this one core conflict. Over here, you've got Porsche. They are masters of what's called scalable luxury. They use the massive industrial power of the Volkswagen Group to build hundreds of thousands of just incredible cars. Then, you've got Ferrari. They are the guardians of scarcity value. Their sacred rule? Always produce one less car than the market wants. We're talking two completely different philosophies for getting to the top.
And this strategic divide, well, it was thrown into the spotlight in the 2025 fiscal year. I mean, the numbers that came out told a really fascinating story. They revealed the core strengths and, some of the hidden weaknesses of each company's entire game plan.
So let's start with Porsche. Look at that number. Over $41 billion in revenue. That is an absolutely massive figure. This is the power of scale, right there. It shows you they are a true industrial titan, way more than just a niche sports car company. But just hold that thought.
Now, look at their operating profit from all that revenue. Just $467 million. I mean, when you see those two numbers side by side, it's genuinely shocking. And the immediate question that pops into your head is,
yeah, seriously, what happened to all that cash? How can a company with that much revenue post a profit that seems, well, frankly, kind of tiny in comparison? The answer, it turns out, is a classic and pretty controversial financial move.
It's a strategy that analysts call kitchen sinking, and the idea is actually pretty simple. If you're already having a rough year, you just throw every possible loss and write-down you can find, literally everything but the kitchen sink, into that one year's results. It clears the books, it sets a really low bar, and it makes all your future growth look way more impressive.
And this was Porsche's big kitchen sink moment, a huge, nearly $2 billion write-down. Analysts have connected this directly to a major strategic pivot. See, when Porsche decided to delay some of its key electric vehicle models, all that money they'd already invested had to be accounted for. So they took the hit all at once, which basically wiped out their profit for the year and reset expectations for the future.
now, for the other side of the story. This single quote from the HDN Research analysis just puts everything into perfect perspective. It perfectly captures the absolutely radical difference in how these two companies make money. Let's look at the hard numbers.
And this table just lays it all bare. It's wild. Check out the revenue line. Porsche's 5 times bigger. But then, look at the profit. Ferrari made 5 times more. The entire story is right there in the last 2 rows. Porsche built over 279,000 cars. Ferrari, they carefully crafted just over 13,000. And that incredible discipline lets them command an average price that's nearly 4 times higher than Porsche's. It's a different universe.
And visually, the difference in just sheer volume is staggering. I mean, it's not even a competition. Porsche is playing an industrial game, even though it's in the luxury space. Ferrari is playing a completely different game, one of, artisanal scarcity. And that's exactly why their financial results are just worlds apart. Okay, so we've established their business models are night and day. Now, let's look ahead. Both of these companies are facing the exact same massive challenge, the electric transition. So the question is, how do you keep the soul of a performance car alive when the internal combustion engine might be going extinct? Their EV strategies really just mirror their core beliefs. Porsche is taking a multi-pathway approach. They're doing combustion, hybrid, and full electric, and they're using shared VW Group platforms to handle the insane costs. Ferrari, on the other hand, calls itself tech neutral. They're saying the V12 is still the heart of the brand, but at the same time, they're building all their own electric tech in-house to make sure it feels like a Ferrari. So Porsche is adjusting its EV rollout to meet demand, while Ferrari is just methodically counting down to its very first EV in 2026.
But here's where things get interesting, where their paths actually meet. Both of them are investing a ton of money in synthetic e-fuels. This is their big strategic hedge. It's a bet that they can use these new carbon-neutral fuels to keep the amazing sound and feel of a combustion engine alive for their most famous models, even after those 2035 rules kick in.
And this is really what's at stake, is that intangible thing analysts call the engine soul. You know what I'm talking about. The sound, the vibration, that emotional connection you get. For cars like the Porsche 911, it's the brand's actual DNA.
So the biggest question for both of them is, how do you translate that feeling into a new electric world without losing all the magic?
Which brings us to the real heart of the matter. For Porsche, the challenge is this huge, expensive pivot from being an industrial luxury company to becoming a software-defined mobility company. For Ferrari, the challenge is a bit more philosophical. How on earth do you justify a nearly $600,000 price tag when that iconic V12 roar is replaced by, well, silence?
Okay, let's bring it all home for the final lap. If you were looking at these two companies not just as a car lover, but as an investor, what does all this tell you about the risks and the potential rewards for each one?
Right. So putting your money on Porsche is really a bet on a massive industrial transformation. You're betting they can get through this tough, painful transition and come out the other side as a leader in electric performance. The risk, as analysts are pointing out, is that their valuation has already kind of dropped from a luxury company to a more standard industrial auto company. Now, an investment in Ferrari, that's a bet on pure brand power. You're betting that the prancing horse logo is so powerful, so desirable, that it doesn't matter what's under the hood. The risk there is dilution, that a silent electric car, no matter how fast, might just damage the very soul that makes a Ferrari a Ferrari.
So this has been a really high-level look at a super complex rivalry. The full data-packed deep dive that we used for this explainer comes from the analysts over at HDIN Research. You can find their complete report on their website if you want to go even deeper. And that just leaves us with this final big question. As the roar of the engine starts to fade, what's going to be more valuable? The ability to build 1 million brilliant electric cars, or the ability to sell just a few thousand that feel like priceless pieces of art? The industrial powerhouse or the legendary artisan? The next decade is going to give us the answer.